us, thank you very much for spending your Tuesday with us. I want to start with a little bit of who Atlas is, why you're here, and then we'll get into today's presentation. First and foremost, Atlas has 3 distinct business lines, which gives us a unique perspective into real estate. First one is we have a robust property management division. We roughly have 3,200, 3,300 units that we manage in 2 different states across 4 cities. We're exploring some other cities and states to expand into. We were going to do that this summer. COVID sort of changed things. Kind of why reason we're doing a webinar today instead of doing this live, because COVID changes things for all of us. So, you know, it's the new world that we live in, right? So we have the property management division. Second thing is we have a robust brokerage, and our brokerage is comprised of 2 specific parts, one retail side and one investment side. What we're focusing on today is the investment side. And the investment side is something that we've been doing these classes, these presentations for 6-7 years now. They're always free. Please join us. We do them at noon every Tuesday as a way just to communicate to the greater world out there of how we think about real estate. And then the third branch of our business line, we have a very robust institutional line of business. And when I say institutional, these are institutional investors. Most people have heard of a small real estate company called Zillow. Zillow is one of our clients. They unpaused buying in Denver Tuesday of last week. So they're buying in Denver, where we are headquartered, in Fort Collins and Colorado Springs. We do all of their active buying. We also have a few large institutional companies that buy through us. Invitation Homes, largest homeowner in America, owns 100,000 homes. Pathlight out of Chicago, First Key out of New York City. These are part of our institutional arms. And this gives us a unique perspective into real estate. And when I say retail versus investment, here's the big difference. Retail is anything, I consider retail anything somebody's going to buy and move into. I consider investment properties anything else. Somebody that's going to buy this for what they're going to use it for, that's what I consider investment real estate. So the retail side of our business all comes from our Zillow leads. We are not your typical Keller Williams, RE/MAX, not that there's anything wrong with that, but we're not a bunch of 1099 brokers running around trying to sell real estate, trying to put money in our pockets. We have this set up in a much different process, and that's what makes us different. I'd like to introduce Jim Doolittle, who's going to lead our presentation today. I'm going to moderate. Jim has a unique perspective on real estate and different markets. He owns 28 single-family homes, 13 in Memphis, 15 in Denver. And our presentation today is titled, What the Gurus Got Wrong, or Why Are the Gurus Wrong? And it's one of those things that Jim has a unique perspective because he was sold a bill of goods in 2 different markets, and he's going to talk us through what makes those markets different. So Jim, I'd like to turn it over to you. How are you doing?
Doing great. Thanks, Mike. Here, I'm going to go ahead and do a screen share here so we can kick off this presentation. Sorry, let me get back to the beginning here. Cool. So, you know, there's a lot of gurus out there, and let's talk about, you know, what is a guru and what is their motivation? And it kind of depends on which guru we're talking about. So, you know, like authors is one. There's so many books out there on real estate investing and videos, and a lot of them are great. Like I credit Robert Kiyosaki, Rich Dad, Poor Dad, sort of that book was the beginning of changing my life. It was very powerful. There's coaches out there that will sell you coaching services, whether that's live or pre-recorded coaching sessions. And then there's speakers. These are the folks that go around the country booking these large hotel banquet rooms, spending a lot of money, and they're motivated and filling those seats, charging you something to get you in there to fill that seat. Then there's brokers, obviously looking for a commission. That's us, by the way. Wholesalers, they like to lock up properties at a certain price and then mark it up and wholesale it to an investor. That's how they make their money. And then our most favorite, Mike's and I's, our favorite is financial planners, right? And these are the folks that are selling you stocks and bonds and mutual funds and commodities and you know all the stuff. And obviously they want to sell you products that they have, you know, that they can make a commission on. So these are the kind of gurus. This is kind of what we're talking about when we say gurus and what their motivations are. It's important, I think, to tell you what is our motivation, right? So you have some context for all of this. Mike and I and a lot of folks at Atlas, we're very passionate about educating our clients and moving them, progressing their knowledge so that they can move closer and closer to financial freedom, right? I did it. Mike's done it. There's a lot of people in our company that have done it, and it's a fantastic thing. The way we do that is we grow our clients' wealth and income through real estate, through rental properties, right? It's not a sexy business, but it is a very profitable business.
Hey, Jim, one thing I just want to add for everybody out there.
Yep.
At Atlas, one of the things that we were trying to do is just solve problems. And I think one of the problems facing America right now is and I don't mean in the last 2 weeks, I mean in the last 10 years, is this growing gap between the have and the have-nots. I think COVID has exacerbated that. I also think that people just haven't saved enough money for retirement. People simply can't retire, and they're worried about retirement. And the stock market crashed, in March. It's almost all recovered, but people are worried about that. And we get to sit down with our clients and help them try to solve financial problems. So, and I know I say that and it sounds grandiose, but we really, really focus on that. And I think that's a really important thing for our viewers to know.
Yeah, absolutely. And then our motivation, another motivation of ours is to sell our clients the assets. We specialize in investment property, usually under $1 million, occasionally some that are bigger than that, but for the most part, under $1 million. That's single family homes, that's small multifamily. That's where you get some amazing returns. And then if we move you into an asset, well, just the standard brokerage commission. There's not any smoke and mirrors or anything.
Jim, question for you. You say standard commission. Why is Atlas different regarding commission?
Well, you mean in how we compensate our employees?
Yes.
Is that where you're going? Yeah. I'm glad you brought that up. So I'm a broker at Atlas, and I'm on a salary. I don't get paid a commission, which is actually a beautiful thing, because that means my behavior and my incentive, my motivation is completely in line with our clients. And if they don't want to buy anything, that's great. That's fine. If they want to buy something, I'm not going to push them one way or the other because I get a higher commission. I just get a base salary, and that's how Atlas compensates its brokers.
It's how all of our brokers are. And I think it's really, really important because it means, as Jim said, that we have your best interests in mind. We're not trying to just sell you something so we can get a commission and move on. We're trying to do the best thing for your personal situation.
Right. And so in all the different venues where Mike and I find ourselves educating folks on real estate investing, people are often suspicious about, what is it you're trying to sell me? Is it, what's the hook coming at the end of this? And just know that in this webinar, there is no hook. There's nothing at the end of this. We don't have anything to sell you. We're just doing this because we're so passionate about financial freedom through real estate.
The way I tell people when we do these live or online, we have no book, we have no class. There's literally nothing to sell you. At the end of this, if you want to meet with us, it's free consultation. We'll look at your portfolio, we'll review it, we'll make recommendations, but we never get paid unless you transact on real estate. And the truth of the matter is, we're going to do it for free. We're going to do it for free. We're going to help you out because we like real estate so much, and we can work together to help a problem, but there's nothing to sell. The follow-up is going to be, hey, do you want to talk about you? Whether that's in person or on the phone, do you want to talk about you at some future point? That is my promise to everybody listening. Cool. So Jim, how does Atlas do this?
So that's our motivation. Nothing to sell. Only way we make money is through real estate commissions. But what is our method? And we have a very unique value proposition to our marketplace. So like we said, we put clients into performing assets, and we operate in markets where we have a very bullish outlook on the 20-year picture, right? So Denver, Fort Collins, Colorado Springs, Phoenix, Arizona, and then Mike's talked about some new markets that we're going to have coming online here in the not too distant future. But these are markets where we can, with a high degree of certainty, predict 20 years from now that these assets are going to be worth quite a bit more than they are today. There are some markets, we're going to talk about some of those markets where you can't make that conclusion. They have very little appreciation. There are some markets that we're not going to talk about today that actually have negative appreciation, right? And then cash flow. We all love cash flow. I love cash flow. I feed my family off of cash flow. And so that's a very big piece. And then we also offer construction services. This is something I think is unique in that if we're project managing something for a client, we only mark it up 10%. That markup of 10% probably means we can still do it cheaper than you can do it on your own. And the standard markup from my experience has been 30%. So I think that's a very, very fair number. And then I like to say property management like no other. And we'll talk a little bit more about our property management here in just a second. And then another method is trading assets in and out of our clients' portfolios, right? Sometimes when you're holding on to a client or holding on to an asset for a long time, it's developed all this equity, and yet the cash flow is the same or maybe slightly more. But for the most part, you have this huge amount of equity. A lot of us do. Mike does, I do. And we put together a plan for capturing that equity and redeploying that equity into a larger asset so that they can just accelerate their creation of income and wealth. And I like to say we do all the work.
And just say it like this as a very simple example. Really simple example. I have a rental property. First place I ever bought it in 2001. I probably have $240,000 in equity on it, and I literally make $150 a month on the positive cash flow. I need to sell that thing and go buy something bigger, better performing. And Jim's actually the one, I don't know, maybe a month ago said, "Why are you not doing this?" So he's gonna help me do that.
Got to practice what you preach, Mike.
Absolutely.
Yep. Cool. And then real quickly, what is different about Atlas? I don't know anybody who operates in this fashion, certainly not in the Denver market or any of the other markets that I invest in. But our property management is quite unique. We're similar in the standpoint of our fees are the same as your standard property management company, but our results are a lot better. And by results, I mean for the investor, for the owner, the results are a lot better. If we do a repair, say there's a leaky toilet, we go out, we don't mark that up, right? We just do that at our cost, we pass it through. And that means we're not out there looking for things to repair, if you know what I mean. I think that's a really unique feature. If it's a bigger project and there's management, there's multiple vendors, and we're coordinating, like I said, it's only a 10% management fee, and that is well below the industry average. And this is my favorite part, or it's one of my favorite parts about Atlas Property Management is the single point of contact. So Mike, as you know, I don't know if I told you, but I just fired my 4th property management company in Memphis this week.
4th.
I don't think I've told you that.
No, you haven't. That gives me heartburn just thinking about it.
I know. And I think I'm on to the last one. So I'm really nervous. This one has to work out.
Nope. But Hey, Jim, practice what you preach, baby. We got to get you out of Memphis.
I am working on it. I'm looking for an elegant solution, but it might not be so elegant. And then, so the single point of contact, right? When I'm working with my property management down in Memphis, Tennessee, the burden of putting all the pieces of information together to understand what's going on is on me. Meaning I've got to talk to the leasing department, I've got to talk to accounting, I have to talk to construction services, and then I have my client services person. And at Atlas, we have a single point of contact. So if you have a question or a concern, you can voice it with your Atlas property manager, and they will 90% of the time know the answer. If they don't, the burden is on them to go inside the company and get the answer. And so that is just a beautiful thing, and the communication is absolutely amazing. And then I lied. This next one is actually my favorite part about Atlas property management. So it's how we compensate our property managers, right? They are compensated based on collections. So if a property is vacant and they're not collecting, it's going to impact them and their lifestyle. If it is occupied and they're not paying, same thing. It is going to impact their income and their lifestyle. So what that does is it means that they are laser focused on keeping properties occupied and keeping the payments coming in. And that's really job number one as far as, an investor making money.
Well, and let me speak a little bit to property management. When we built the Atlas Property Management Company, when we started it years and years ago, we did it with the owner in mind, the investor first, because we are real estate investors ourselves. And I don't like most property management companies because they are not built and designed to run things the way an owner would. So we built it specifically with that in mind. And the beauty of this is your property, we treat it like ours. When we sell you something, it becomes a one-stop shop. We want you to buy real estate, and then we want you to get out of the way. Go back to being a doctor or a school teacher or a lawyer or a stay-at-home mom or retired. Go do whatever it is you do and let us deal with the real estate, and it becomes a one-stop shop. Most salespeople sell you something, shake your hand and say, good luck. We're not going to do that to you. We really, really, really want you to go be you. We'll deal with the real estate headaches. And that's the way we built our property management company. So Jim, what are some of the myths of real estate investing?
Okay. So one of the myths is if you buy cheap property, you will get higher cash flow. So some of the cheap markets out there are Memphis, Birmingham, Jacksonville, Cleveland. There's others. Those are probably the biggest ones. I think the ones that are most known for being cheap markets to invest in. And you have to be careful. I'm going to pick on Memphis today just because I have 13 doors down there. But really, when I talk about Memphis, I'm really talking about all markets that have cheap real estate. So what do these gurus say? These are brokers and wholesalers. They're trying to bring investment dollars into their market. And in order to do that, they promise higher cash flow. But unfortunately, they manipulate the operating expenses. So they will say like that the operating expense ratio is 30% of gross rents, right? Now, we commonly in our business express operating expenses as a percentage of rents. That's no problem. We all do that. It's the 30% number that is the problem. And here in Denver, 30% where rents are $1,800, let's say on average, at least my average, 30% operating expenses are truly 30% of rents. So it's actually a very good number here in Denver. It is not a good number in Memphis, but the gurus talked me into that same 30%. By the way, the rents in my average rent in Memphis is $800 instead of $1,800, here in Colorado. But what's the real story? So cheap assets obviously bring low rents, like I said, $800. But the repair costs, repairs are the big thing, are really about the same, right? So if I'm turning a property in Denver or Memphis, I have to do carpet and paint and a few little touch-up things. It pretty much costs the same. Anywhere in the country, it pretty much costs the same.
Think of, as an example, think of a water heater. If you go buy a water heater at Home Depot, whether you're in Memphis, New York City, or Denver or Seattle, a water heater at Home Depot is a water heater at Home Depot. It's the same thing. Yep.
Here, I want to switch the screen share and draw this up for you guys to try to illustrate this point if I can figure this out.
And Jim, while you're doing that, one other thing that I was going to mention during property management that I think the audience would like to know, and that is our rent collections generally at Atlas across our 3,300 doors are roughly, pre-COVID, roughly 97, 98%. The month of April, this April, we collected just under 95%. So it was about a 3.5 point drop from normal collections. Right now, as of May rent collections were about 1%, maybe 1.2% off of normal rent collections. So really what that means is the Atlas team and our property management has done such a good job that our rent collections, the COVID change has been virtually negligible. And that's a really, really strong testament to our team of property managers. And I think that's just important to note because it's relatively unaffected. Now, are we going to fall into a greater recession in the future? I have no idea. What I do know is that right now, I feel pretty good. Back to you, Jimbo.
Thanks for giving me a head start here. I get to draw this up here. So let's talk about, Denver, where real estate is not cheap compared to Memphis as a proxy for all the markets in the country where real estate is cheap, right? So in Denver, rents, my average rent on my portfolio is $1,800. Those happen to be single family homes. In Memphis, my average is $800. Those are also single family homes. So it's apples to apples, and obviously a big difference. And like I said, an operating ratio of 30%, an OPEX ratio of 30% in Denver is a fair number. That is a good number. I use that. I've always used that since I started in 2014, and my portfolio holds that number to be true even today. And the myth, and this is the catch, the big number and the whole big point of this whole slide, is it's not 30% when the rents are only $800. My portfolio is actually, my portfolio is actually running at 47%. The gurus don't tell you that. That's where they misled me. And I know they're misleading others to bring investor money into markets where real estate is cheap. So what does that mean? So if this is 30%, then my operating expense is going to be $540 here, $240 here, and $376 here, right? Meaning when it's all said and done, my NOI, this does not take into account the mortgage payment, but my NOI, net operating income, right? It's 560 here and 424 here, right? So, okay, well, that's interesting. But let's say, like I said earlier, that repairs cost the same more or less in any market. Let's take the assumption that we're turning a property, we're putting in new tenants, and let's say it costs $2,500 for a turn. Is that about average, Mike, would you say?
I think it's actually high, but let's use it. It's fine.
Okay. Carpet paint and some other things, right? Okay. So in Denver, that $2,500 for that turn actually represents 2 months worth of net operating income, right? In Memphis, where the properties are cheap and the rent is low, that actually represents 6 months worth of net operating income. So I should have known this. I should have done this math before I went to Memphis, but I didn't. I kind of fell victim to some sales pitches from some of the gurus. And as you know, Mike, I'm trying to rectify that whole situation, and it's a huge mess.
Yep.
So the moral of the story here, what we're really trying to say is that when real estate is low, rents are low, and the operating expenses are going to be a much higher percentage of the rents. And so a $2,500 turn in in Memphis is going to cost you 3 times as much as it does in Denver. So the caution is, going back up here, don't believe this in a market where the real estate is cheap and the rents are low. Don't believe it. Figure out what it is. In Memphis, mine is this. It might be slightly different in some of the other markets that have cheap real estate, but I'll bet it's closer to the 50% range than the 30% range.
One of the things that we focus on at Atlas is the long-term, the 20-year picture. And by doing that, it allows us to assess the actual risk and make good long-term plays. And this is all about expense control. And if you look at most people nationally will tell you that property management expenses nationally run 31% expense ratios. And that's a really fair number in big cities. When you throw it into the small cities, it's just not true. It's just simply not true. But these gurus, they build their pro formas and they build their financial models based on general data. Why? Because most of them don't own any real estate in the markets they're selling in. I would contend, if you're going to invest, look at somebody and say, great, what do you own? Show me your numbers. And that's what makes Atlas one of the things that makes us very different. So Jim, what's the second myth?
Second myth, and these are financial planners that are talking to us. These are the folks selling us stocks, bonds, mutual funds, et cetera, so that they can make a commission on each of those transactions. they're telling us to be careful with real estate investing because of the debt, and the debt can get you into trouble. And they conveniently lump consumer debt with mortgage debt, because we're all trained to, avoid any consumer debt. Consumer debt is like buying a boat on a payment plan.
Why you got to pick on both?
Because I knew that would get you riled up. And I know you didn't put it on a payment plan.
I did not.
And then, but mortgage debt is entirely different. I have 7 figures of mortgage debt. I know Mike does. We don't have any problem sleeping at night. And you have to be smart about it, and you have to set it up in a certain way. You can abuse mortgage debt if you don't do it correctly. But if you do it correctly, which is not hard, the banks will tell you how to do it correctly. It can be an amazing thing. They like to tell you that, remember, they like to use scare tactics. Remember the last recession and what happened to real estate? Well, real estate was actually the catalyst of the last recession. And there are so many laws in place now that that's not going to happen again. We may have another recession, but I don't see real estate being the catalyst for it anytime soon. And the way to make leverage safe, debt and leverage are the same thing. The way to make it safe is, first of all, follow the bank's rules. They understand debt better than any of us ever will. They understand the risks, and they want to set you up for success, because ultimately then they succeed with their, with their debt, with their money, and just follow their rules. A good example of abusing their rules is borrowing the down payment from your Uncle Vinny. Don't do that. You need to come to the table with the down payment. Otherwise, you're 100% leveraged, and that's a very, very risky very, very risky thing. So have at least 20% is usually what they want, and then have a 20% cushion on your cash flow. What I mean by that is, if you had to lower your rents by 20%, and that's a pretty extreme scenario, truthfully, then you could, to keep it occupied and still cover your mortgage payment, your operating expenses and your mortgage payment. So that's how I make.
And just for the difference, that's one of the things that Jim does. One of the things that I do personally, every investment property I own is on a 10-year fixed rate, fully amortized loan, or a 15-year fixed rate, fully amortized loan, because I'm not necessarily doing it for the cash flow. I'm doing it for, I have different methods behind my madness. Jim and I do this together, talk about this a lot, and neither one is wrong. Here's the difference. Jim has a cushion in his rents where he can lower them. Well, I don't have that cushion because I'm paying them off so fast. So what I do is I make sure I have a pile of cash sitting in the bank in a reserve account, so that I know no matter what happens, I can pay my bills. It's the same kind of cushion. It's just depends on what your goals are. And Jim and I have the same long-term goals, but our ways of getting there, while similar, we take 2 different paths, but we still have that cushion. And that cushion, like Jim said earlier, is what helps me sleep at night.
Yep, absolutely. All right. So I guess what we're trying to say is, don't lump mortgage debt with consumer debt. They're 2 different kinds of debt. Mortgage debt, you set it up so that you set it up smartly so that it's a safe loan. You let your tenants pay it off, and it works out beautifully. And it allows you to use our favorite word, other people's money.
It's amazing.
I know, right? All right. Here's the third myth. I like this one. This is one that I didn't put enough weight on when I was a younger investor. And I wished I had. I was buying strictly for cash flow, thinking appreciation is just gravy. If it happens, great. If it doesn't happen, okay. Ironically, I've made far more money on appreciation than I have on cash flow. And I'm going to say it's been somewhat by dumb luck, at least here in Denver. In Memphis, there's not as much, very little appreciation. So that's a completely different story. So what the gurus will say, and these are usually brokers and wholesalers, is that they want you to invest in their market that has high cash flow. In order to get your money there, they want you to think less about appreciation. and because they know they don't have a lot of appreciation in their market. So they kind of sway your thinking over to the cash flow side. And the cash flow is all that matters. But I think we should draw this one up too, because this is, we're talking about leveraged appreciation, and this is how you really create wealth, you know, with real estate. So let me switch back over to the whiteboard.
So while he's doing that, while he's switching over to the whiteboard, this is how we at Atlas think about appreciation. We have several different pillars of our investment thesis. Number one, as Jim talked about, we have 20-year picture. Number two, we have to have positive cash flow, but when you combine those 20-year picture with appreciation and positive cash flow, you get a deal where you make money both ways. Think about some of the markets. Take Southern California, for example. I would be willing to bet that anything in Southern California, with very few exceptions, is going to be worth more in 20 years than it is today. So I can check that box. I like the 20-year picture of Southern California. I'm a Californian by birth. I like the 20-year picture. Here's where I struggle with it. Real estate there is so expensive, and the rents are not as high ratio-wise as the expense of real estate. So what happens is you can't get positive appreciation. And if you can't get positive appreciation, now you're just gambling. All you're doing now is, or excuse me, if you can't get positive cash flow, you're just banking on appreciation. And I want both. In places like Memphis, they're saying, don't worry about appreciation, just buy for cash flow. In California, you're just buying for appreciation, not buying for cash flow. Both of those things, I would make the argument are wrong, and I have the numbers to back it up. I would tell you that if you do a good job and buy for both, you will win. And Jim's going to illustrate this point on this whiteboard about just how powerful appreciation really is.
Cool. So let's say, here's the scenario. Let's say you buy a real estate asset this size. Doesn't matter what it is, single family, multifamily, doesn't matter what market it's in. It doesn't matter, right? And let's say you put 25% of your own money as the down payment. Cool. That's pretty sweet. Now, appreciation in Denver for the last 10 years, Mike, is what, 6.9%?
It's been Denver's up. I think it's a little less, like 6.6 maybe, whatever it is. Call it close to 7. Denver from 2010 to 2020 is up right at like 87% total.
Okay, cool. And then we looked it up the other day. Memphis in the last 10 years is 2.5% appreciation, yep. Right? So it's not so important what these exact numbers are as much as it is the spread between the difference, right? So we're picking on Memphis again as a market with cheap real estate, but low rents. Denver is a market where you get the combination, a nice combination of cash flow and appreciation. And this is why you can create far more wealth in a market that has appreciation versus one that doesn't. So like we said, you put 25% down on this asset, and then let's divide this up into quarters to kind of make this make sense. So here you are on your money, your 25% down payment, you're making 6.9% appreciation in Denver and 2.5% appreciation in Memphis. Okay, that's okay. That's good, not great. But we talked about other people's money. This is the best part about leveraged appreciation, right? So in this quarter, and this quarter of the asset, we're all using other people's money. And here's the powerful thing. So here on this second quadrant of this asset, you're also going to make 6.9% on that. And guess what? You didn't come out of pocket any more than you did for the first quarter of the asset. Same here. You're making another 9.6% without coming out of pocket, and so on and so on. You get the idea, right? And what does that come out to? And your rate of return by using other people's money, let's call it 27%. That's nice. That gets me out of bed in the morning. I like making 27%. Compare that to the stock market. I show that to my former financial planner, and he's got nothing to say. You know, And let's talk about leveraged appreciation in Memphis. It's still a good story. It's just not as good of a story, right? So if it's 2.5, what are we, 5, 10? So 10%. I mean, still arguably better than the stock market, right?
Do you know what the biggest difference in both of these is, though? Jim, how much was your average price of your house in Memphis?
65,000.
And what about your average price of your house in Denver?
Like the current value is
just when you bought it. Oh, right now is Memphis $65,000 for a house?
Yep.
So
Still
he's
65.
10% on $65,000. What about Denver?
My average is somewhere between 300 and 350.
So now he's going to make 27% on a $300,000 house. It's really simple math. I mean, yes, it's harder to get into Denver, but by buying one house in a place like Denver, it's better than buying, I don't know what that math is, 5 or 6, maybe 7 houses in Memphis. That's the beauty and the power of this appreciation story.
Right. Yep. So that's the story about how powerful leveraged appreciation is.
I would, while Jim's going back to the screen, I will just a caveat to this. It has to be the right kind of appreciation. If you look at how the industry got so hurt in 2008, 2009, part of that was just bad investing. And when I say bad investing, I don't mean in the assets they bought. I mean in the manner in which they owned real estate. Because I had rentals through 2007, 2008. They were long-term fixed rate debt, and I was just fine. The people that got really, really hurt were interest-only loans, adjustable rate mortgages. That deeply contributed to the crash, and we do not believe in that. All long-term fixed rate financing, that's the secret to not getting yourself pinched when the economy goes down. Keep going, Jim.
So this is just a slide. I like showing this slide to financial planners and people who have all their money tied up in the stock market. You look at this pink line, this is the S&P 500 long-term average over the last 20 years with the dividends reinvested. Compare that to real estate. This is leveraged real estate. We just talked, like what we just talked about. And it's both the appreciation and the cash flow added together. And you can just see just a drastic difference. So if you're trying to think about where to invest your money and you're thinking about the stock market, I'd say think again, but that's just me.
I believe you, Jimbo.
Well, you know, because I'm all in. I'm all in. I don't have any stocks anymore.
Hey, for everybody listening to, it's 12:39. We're going to try to wrap this up and get to, I know there's at least one question in the Q&A. We're going to try to wrap this up pretty quick. So do me a favor, if you have questions, shoot them our way, because we're going to wrap up these last slides quickly. That way there's a chance for some Q&A.
So let's just talk real quick. We'll wrap this up about a look ahead. First of all, in this world of COVID, if you have real estate and you're worried about it, you're worried about losing it, you're worried about anything related to real estate, give us a call. We'd love to talk to you about it. It's most likely not as scary as you think it is. If you have a portfolio and you want to do a stress test on your portfolio to see how much effect can you endure from COVID, we have a model. We'll be happy to run that, walk you through that as well. And the fears are not nearly as high as they were, say, 4 weeks ago. People are starting to see that more people are paying their rent than we thought were going to. So I think we assumed worse than what's actually happening. So there is a lot of encouragement in the investing world, real estate investing world right now. If you have a portfolio and you're trying to think, well, what should I do to optimize my portfolio? How can I capture my equity, like we talked about earlier, and use leverage to grow my wealth at a faster rate than I am? That's something that I do at Atlas. We call it a portfolio review. I'll walk you through your portfolio, make some recommendations, point out some opportunities, and also point out some of the risks. That's something we're happy to do. And it's free. Everything's free, of course. And get ready to buy. I mean, some of us think that, in all of this turmoil, that real estate values are going to slip. So far in Denver, we haven't seen any slipping. We're starting to see some slippage in Arizona. It's very preliminary, so we're not making any long-term predictions. But hey, I wouldn't mind if real estate values dipped a little bit. It'll be a great opportunity to pick up some more.
And here's the deal, though. Even with the slippage, do the math. So I spent some time doing the math, and I figured out that interest rates are so low that if real estate prices drop 10%, just in general, drop 10%, but interest rates rise a point, your mortgage payment is virtually exactly the same. Meaning that interest rates are so cheap right now, long-term money, man, long-term cheap fixed rate debt is a fantastic hedge against the stock market. It's a fantastic hedge against inflation. It's a fantastic hedge against an economic drop. And remember, we buy for the 20-year picture. We buy cash flow, good properties that also have appreciation over that 20-year picture. And man, if you do that with such cheap interest rates, you win. You just win. And we want to win with you.
Cool, Mike. So those are like the three myths that I kind of have really impacted me. There's a lot of others out there from the gurus. We could probably do this for 8 to 9 hours if we wanted to cover all of it, but I thought those were the most pertinent and the most relevant and kind of the ones that I've, mistakenly followed in my investing career.
Hey, Jim, question for you. Question came in. What's a good cap rate to aim for in a market like Denver for a single family home or a condo?
Yeah, so for single family is not as good a cap rate as multifamily right now. I don't know if that's always the case, but that is the case right now. We could easily put you into a single family with a cap rate of 5.5. Multifamily is probably a half point higher than that in cap rates, 5.5 to 6.
So, and I would say this, some of the biggest firms that are investing in single family homes right now, your big institutional investors, because we buy with them, buy for them, we know what they're targeting. And if you're getting on a single family, a 4.5 to 5 cap, if you can find a 5.5 cap, that's a pretty good deal on a single family home. The question also brought up condos. I would typically avoid condos and I would avoid townhouses because the HOAs eat up your cash flow. It's going to be really hard to find a 5.5 cap on a condo because the HOAs just eat that up. Now, that's not to say that it can't be done, but in general, I typically tend to avoid that. So just there's that too. Another question here, Jim, somebody, an anonymous attendee wrote in, cool slide comparing the S&P 500 versus real estate, but shouldn't one invest in both, considering that the stock market is very liquid and real estate is not? Also, does the comparison show the transactional cost? Just thought it would be fair to call that out, but I do get the point you're making.
Okay, Mike, you know what I'm going to say.
I do.
So I'll acknowledge liquidity is what makes real estate, is one of the challenges of real estate, right? We call it passive income, but ironically, it's really active investing because you're in control as the investor, you're in control of the assets and you have to manage them. And I don't mean property manage, but you have to manage those assets. And they're illiquid, right? To sell a house takes weeks, months. To find a good deal takes weeks or months sometimes. But stocks you can just trade, obviously a couple of keystrokes, and you've purchased or sold a stock. So that is true. Stocks are truly a passive investment, and very liquid. That is one of the illiquidity is one of the downsides to real estate. I admit. In terms of, I think it was diversifying was the other part of that question. A lot of people think that, wow, Jim, when they find out that you're 100% in real estate, I used to be 100% into a diversified stock portfolio and all that stuff. But I am making so much more money in real estate that I just decided to go all in. And I know diversity is a buzzword that makes people feel comfortable, and they say, well, what if the real estate market tanks? You're gonna be crushed. And I'm like, well, what else would I be in? I would be in the stock market, I guess. And the stock market is going to crash along with real estate at the same time. So they're not a good hedge against each other. I'm not saying don't diversify and don't hedge where you can, but don't just think that a diversified stock portfolio is going to grow while real estate slides or vice versa. They're going to go more or less trend together.
And here's what I would say. If if real estate was as easy to transact on as the stock market is, there would have been a pullback in pricing. But because it's not, there has not been a pullback in pricing. And we're going to talk about that here in a second, because there was another question on that, which I really, really like. But think of it like this, is if a financial planner today will tell you that you're going to make 6 or 7% on your money in the stock market over a long amount of time. In real estate, you're going to make roughly 4% in terms of appreciation, the national averages, over time. But the beauty of real estate versus the stock market, in the stock market, you only get paid one way, and that's as it grows. Real estate, I actually get paid 5 ways. 2 of those are taxes, so we'll leave those away. The other way is I get paid 3 ways. I get paid in long-term appreciation, I get paid in cash flow, and I get paid every time my tenants pay me, and I pay the bank. That debt reduction, it's a sneaky way to build lots and lots of wealth. And I get paid all 3 of those ways. So if I'm not getting the appreciation, which is happening right now, and trust me, I won't flip off the camera. If I don't get the appreciation, I'm still getting the positive cash flow, and I'm still getting the debt reduction. And that's the beauty. In terms of the liquidity issue, and those of you that know me know that I went out and I actively worked on getting lines of credit, which I did against some of my investment properties. I actually signed a loan 2 weeks ago with my bank where they charged me $3,000 to do this, but they opened up a $250,000 line of credit. Now, why did I do that?
Hey, Mike, I lost you. Oh, looks like we lost Mike. I don't know if you guys still have me or not. Maybe he's coming back on, but yeah, I want to make a point on that as well, that somebody pointed out, in fact, it was my former financial planner, when I was comparing the returns I'm getting on my real estate portfolio, all the different returns that Mike was just talking about, comparing that to what he was helping me get through a diversified portfolio. And it wasn't even close. And he was quick to point out the difference. And that is, he's like, it's not an apples to apples comparison. The reason I'm getting so much higher returns on real estate is because I'm using leverage. And you don't use leverage on the stock market. You can, but it's highly risky. Don't do that. But we use leverage on real estate all the time, all day long. So basically we're able to, use 75%. We're able to use 75% of somebody else's money and get all the benefits, of 4 times the size of the asset than we would otherwise be able to buy in the stock market. So leverage is the main reason that real estate outperforms the stock market.
We have an anonymous attendee, but I think we can guess that this anonymous person wrote in, I've heard there's an incredible investment broker who lives in Phoenix and is currently accepting new clients. Jim, do you happen to know what his name is?
I can't think of anybody.
I know he's a huge Seattle Seahawks fan. So for people that are participating from Seattle, he's a huge Seahawks fan. So call him. His name is Larry, and he's amazing. Larry, thank you for writing that because that's funny. Question from Chris. Jim, have you seen prices begin to become more attractive, or do you believe that they will after the eviction ban is removed?
Value, we're talking about values, right?
Yep.
I think the best study that I've seen is one that's actually put out by Zillow. It seemed like it had the least bias in it, in my opinion. And their prediction was that values, and this is a national number, by the way, values would slip 3 to 4% in the remainder of 2020, and then take all of 2021 to recover. And I thought, well, that's no big deal. I mean, I'm investing for the long term anyway. I don't have a problem if my value dips by 3 or 4% because I'm still collecting my cash flow. I'm still paying down my tenants are still paying down my debt with principal reduction. So, if I had to sell something, right now and values had slipped 4%, well, truthfully, I've already made so much appreciation since 2014 that it's like a drop in the bucket. So to me, a single, 3-4% drop in real estate values in the short term is nothing. It doesn't worry me at all.
I would echo that. I would also say that this goes into the question that was written in about the transactional cost in the S&P slide. And the truth is, real estate costs money to buy and sell, but it's compared to the, as Jim pointed out so eloquently earlier, the 27% that you're making, it doesn't really matter. It's relatively, it's a really small number. And when we sell out of stuff, what we do is we 1031 exchange it. I told you earlier about the first house I ever bought that I've owned for 20 years now almost. Well, there's $250,000 in equity in that. My biggest thing is not the transactional costs and I'm going to have to pay brokers. It's how do I escape taxes? I don't want to pay taxes. So what do? I 1031 exchange. Jim, that gives me an idea for another, write this down. We should do a webinar all on how to use real estate and escape tax. Cost seg, all the stuff that we know. So that'd be a good one. But I 1031 exchange it and I don't have to pay any taxes. Someday, if I sell the asset, I'm going to have to recover all the taxes that I owe from the 1031 and the new taxes. So what is Mike Hills going to do? When I tip over someday, I'm going to leave all my properties to my kids. They're going to get what's referred to as a step up in basis. And I've effectively figured out how to escape taxes forever. And it's a really, really neat trick. Hey, Jim, another question. What do you think about getting 0% business credit to finance a down payment on a home to start out?
I don't know. I don't know the business well enough. I don't know what that does to, I'm a little bit leery about recommending putting debt onto a business that I don't know anything about that business and whether it could service the debt. So, I don't know. That's a tough one.
So I would say if you're just starting out, here's the thing. When I was starting out, my first 5 rentals, I did what's called house hacking. I lived in each one of them, moved, put as little money down as humanly possible because I didn't have any money. I didn't have any money to put down. Today it's a different story, but I bought my first house 19 years ago, and then 17 years ago, and then 15 years ago, on and on through the 2000s. That's what I did. I bought a house, I put as little money down as possible, moved and did it again through the 2000s. Now, our millennial friends have dubbed that house hacking. Well, I didn't know what that was. You know what I was called? Crazy. My father called me crazy. My friends called me crazy. Like, what the hell are you doing? And
you still are crazy.
I still am crazy. I mean, you got a little ponytail. You guys like it? Here's the thing. Today, all those same people that called me crazy are like, dude, can you coach me how to do this? That's why we do these webinars, because it can be done. So is it risky? Yes. But back then, I didn't have anything to lose. So I was financing everything I could, as much as I possibly could. A, because I didn't have any money. And B, because guess what? The beauty of this is that it works over the long term. So there's that. Another question came in. Josh asked where we can find these. If you go to our YouTube page online, you can find all these recorded messages. And we do these same things every month. We do, before everybody logs off, we got 5 more minutes unless people still firing questions. One of the things that we will do, we do these every month. We record them all. We have women's events. We have house hacking events. We have lots of different presentations with which just to coach and guide you through this. So question. I am seeing the banks are tightening on HELOC programs. They have moved the DTI, debt to income, from 75/85 down to 65%. I love using equity to purchase other properties. The question is, do you think the banks will loosen up on specialty products soon? Do you have any referrals for banks that are offering HELOCs? If you wish to share off the record, it looks like a broker, AJ Shows Colorado. So AJ, do me a favor, email us and I'll give you some bank referrals. Absolutely. Jim, what do you think the banks are going to do with HELOCs?
Dude, I don't make any predictions on banks. I've been so wrong with lenders in the past, and they are in this world of uncertainty. I think they're doing the best. They're changing things, tightening things down, trying to protect their own balance sheets. And I can't say that I blame them, but it is frustrating to investors because I actually lost the deal in 3 days before closing because the bank, and I won't mention their name, the bank made a rule change in the 11th hour. They required more capital reserves from this guy, and the buyer didn't have the money. And so they terminated the loan application in 3 days before closing.
I would tell you that I think banks are likely to continue to tighten. Banks are probably not going to loosen until they come through this entire. Tony just brought me lunch. Thank you, Tony. Banks are likely to, I think, if I had to guess, I would say they'll continue to tighten until they're sure that we're through this uncertainty. And I don't know when that's going to be, which is why I went out and got a HELOC right away. But there's banks that are lending. It does depend on the strength of your own balance sheet, the rent that you own, the rentals that you own, that kind of thing. But it'll happen. And like every down market, it'll cycle through. It'll get tighter and tighter and tighter, and then it'll get looser and looser and looser, and then tighter and tighter. And I mean, it's just, now, the timing on that, man, that's anybody's guess. But I think it's likely to get tighter sooner rather than later. Jim, no more
Mike,
questions?
Let's commit to this next webinar based on some of these questions. Let's do one on all the profit centers. Like, we make all the 4 ways we make money as a real estate investor, and then the other tax benefits. Kind of do an overview of all that stuff. I sometimes pinch myself when I'm doing my tax. I don't do my taxes, but when it comes tax time, because the tax rules are written so much in our favor, I feel like I'm doing something illegal. But my CPA swears I'm not. So why don't we do that? Tax benefits and all 4 profit centers. Make that our next webinar.
Great. We have another webinar we do these every Tuesday, noon Denver time, which would be 11 a.m. West Coast time, 2 p.m. East Coast time. We do these every Tuesday. They're always free. If you have any questions, text us, call us, email us in, and we can talk about your situation. Everyone, thank you for attending. I really appreciate it. There's no more questions, so we're going to sign off. But really appreciate your time, your energy, your effort. Go, instead of sell something, as I tell our sales team, buy some shit. It works, and you can change your financial future. So thanks, guys. Jimbo, any signing off comments?
Nope.
Awesome.
Thanks, everybody.
Thanks, team.